Okay, so welcome to this introductory video about auditor independence. Auditor independence is very important because the whole purpose of an audit is to provide an independent opinion on a company's financial statements. So the reason why we don't have a company audit itself is because a company then would not be issuing an independent opinion. So we have independent or outside audit firms who come in and audit a company's financial statements. Let me run through the objectives and the reading and the questions for this seminar. In terms of objectives, first of all, we'll be talking about how auditor independence might be affected by something known as opinion shopping. So this is where companies might try to obtain a clean audit opinion by changing their auditor. And we'll have a student presentation that will discuss this topic. Relating to that, I'll talk about the requirements of AU 315. This is an auditing standard that is relating to the communications that should take place between a predecessor auditor and a successor auditor when there is a change of auditor. And the whole purpose of AU 315 is to increase auditor independence by improving communication from the outgoing audit firm to the incoming audit firm when a company decides it wants to change auditor. And then the third objective, you should be able to explain by the end of the seminar what the auditor independence rules are for public and private company audits. So these rules are different depending on whether a company is public or private. And I'll talk to you about the private company rules, which are laid down by the AICPA. And then there are some additional rules that apply to public company audits. And those rules are laid down by the PCAOB. So those are the objectives for the seminar. Here's the reading that you should do in advance. So you should read through this seminar outline so that you know what class questions are coming up. And also there's a student presentation in this week's seminar. So the materials for that presentation are in this outline. I'm giving this introductory video now, so you're watching this. To help you answer question 3, there's this study here in the Journal of Accounting and Economics. This is a study that I wrote. This is relating to the revolving door between audit staff and audit clients, where an audit staff member goes to work for an audit client. What kind of independence issues does that raise? Reading number 4, this is relating to question number 4. This is about the PCAOB's restrictions on the tax services that auditors are allowed to provide to their clients. And then there's a couple of additional readings here which are voluntary, so these are not required. But if you want to find out more about auditor independence issues, you can have a look at chapter 4 in the Aarons, Elder, Beasley, and Hogan textbook, and also the AICPA Code of Professional Conduct. Then I have some readings relating to the student presentation. So these are really mainly for the students who are going to be giving the presentation. Of course, those who are not giving the presentation can read them if they feel that they have time as well. So that's readings 7, 8, and 9. So one of the questions we'll be discussing in the seminar, we'll go over some questions relating to the AICPA rules. So question 1 is about the rationale for these rules, right? Why are these rules in place? How can those rules help to protect auditor independence? Question 2 is a kind of mini case study question where I'm asking you to apply the AICPA rules on auditor independence to a particular situation. Question 3 is about the revolving door, where a member of an audit team accepts an offer of employment at an audit client. So there are some questions here for you to consider. And then question 4 is about the PCAOB's restrictions on tax services. So these restrictions were not part of SOX. They were introduced after SOX, after the Sarbanes-Oxley Act in 2005 and 2006. There were 3 new rules, Rule 3521, 3522, and Rule 3523. So this question 4 is asking you why these rules were introduced. What was the purpose of these rules? Then we have a couple of multiple choice questions, and then here's the information for the student presentation. So this is an article relating to a company called Overstock.com, which was accused by an online blogger of opinion shopping. Okay, so there's some information there relating to this company. And then here's an article from Accountancy Age in 2013, which is talking about financial directors, right? How much do they want auditors to really be skeptical and to really be independent? Okay, so those are some articles and a couple of questions here. One is relating to the Sarbanes-Oxley Act, which requires audit committees to take responsibility for appointing and changing audit firms. So why was this requirement introduced? And do you think that given this requirement, management still have opportunities to engage in opinion shopping even after SOX? For that question, the reading that's most relevant is reading number 9. Okay, so there's quite a bit of information in reading number 9 there. The other information, what information must the company disclose in its 8K filing when it changes auditor? What is the likely impact of this disclosure requirement on opinion shopping? The main reading that will help you to answer that question for the student presenters is this one here, AU section 315. Okay, and reading number 8 is also some information on the evidence for opinion shopping. Okay, so that's what reading I expect you to do before the seminar. Let's make a start on the material for the Auditor Independent Seminar. So as I mentioned before, these are the learning objectives. We'll have a student presentation to talk about how opinion shopping could affect auditor independence. Secondly, what are the requirements of AU 315? And thirdly, what are the independence rules for public and private company audits? Okay, so we'll start off the seminar by having a presentation. So by way of introducing this presentation, I'll just point out that SOX requires audit firms to be appointed by audit committees rather than by management, right? And so we'll talk about the reasons why that is, who really in practice controls the auditor hiring decision. Okay, so we'll have a student presentation on that topic. Now, relating to that topic is the whole issue of what happens when there's a change of audit firm, right? So in particular, when there's a change of audit firm, the predecessor auditor, that's the auditor who used to audit the company, that auditor will have information that may know problems that exist at the company that are not known by outsiders. So AU 315 requires communication to take place when there's a change of auditor. In particular, the predecessor and the successor auditors need to communicate with each other. And the reason for this is to alert the successor auditor to any concerns that the predecessor auditor might have had about either management's integrity or about some accounting issues that arose during the previous audit. Okay, so these communications are regarded as vital for helping the successor auditor to become just as well informed as the predecessor auditor. However, there's some doubt about whether these communications are really effective in practice. So to illustrate that, I'll talk about a couple of companies where there were auditor changes and where it is argued that actually the predecessor and successor auditors didn't really communicate with each other properly. So the first company is a company called ZBest. We'll talk about this company in quite a bit of detail later in the course, but for now I'll just explain to you that there was a fraud taking place at this company. The architect of the fraud was this guy called Barry Minko, that's this person here, who actually only just got out of prison in 2019. He committed his fraud way back in the 1980s. So he was running this carpet cleaning and building restoration company called ZBest. All right, so that's the first company I'll talk about. And then the second one is a company called Raymore Investments. This was a financial firm in the United Kingdom. Okay, so why was there an issue at ZBest in terms of auditor changes and communications. Well, in just 5 years, ZBest employed 3 different audit firms, which is quite unusual because companies tend to use the same audit firm year after year. Okay, so it's unusual for a company to be changing audit firm as often as ZBest did. It started with a small one-person firm called George Greenspan. Then it moved to Ernst & Whinney, which was the predecessor firm of Ernst & Young. And then it moved to Price Waterhouse, which is the predecessor firm of Price Waterhouse Coopers. Now, subsequent to this fraud being discovered at the company, again, I'm not going to discuss here what the fraud was. I'll come back to this later in the course. But there was a fraud at this company. And afterwards, questions were raised about the fact that the company had twice changed audit firm and how good were the communications between the auditors. So when this was looked at by regulatory investigators, what they found is that the communications didn't really work as they should have done. So George Greenspan stated that Ernst & Whinney did not contact him for information. Okay, so when the company switched from George Greenspan to Ernst & Whinney, it's incumbent upon the successor auditor, that is Ernst & Whinney, to contact the predecessor auditor to ask them if there are any circumstances that they need to know about before accepting the engagement. Okay, so that's something that Ernst & Whinney didn't do, right? George Greenspan here is saying that Ernst & Whinney did not contact him to find out what was going on at this company. Now, when the company switched from Ernst & Whinney to Price Waterhouse, Price Waterhouse did contact Ernst & Whinney to ask what circumstances there were surrounding the change of auditor. And Ernst & Whinney told Price Waterhouse that there had been no disagreements with management, and they said that despite the fact that actually Ernst & Whinney resigned because the auditor had growing concerns about ZBest's accounting. Okay, so this is a case that really didn't reflect very well upon Ernst & Whinney. They kind of failed in 2 respects. Firstly, when they took on the engagement, they didn't contact George Greenspan to find out what was going on at the company. And then when the engagement moved from Ernst & Whinney to Price Waterhouse, Ernst & Whinney didn't tell Price Waterhouse about the accounting problems at the company. So that was the first example. The second example is a UK financial company called Raymore Investments. Again, this was a company that was involved in fraud, and it was later looked at by the regulatory authorities. And the director of Raymore Investments, this person was called Mr. S. He was the person who engaged in the fraud. And before the fraud was discovered, Price Waterhouse decided to resign. And they resigned for 2 reasons. First of all, they noticed that Mr. S's personal accounts had been intermingled with those of the company. Okay, so he was basically looting the money out of the company, right? So there's this intermingling. He was using the company's money for his own personal needs. And then secondly, there was a lack of cooperation from this Mr. S, this person involved in the fraud, during the audit. Right? So Mr. S had not cooperated with the auditors, and there's one instance of outright deception. So Mr. S had tried to deceive the auditors. So this is what Price Waterhouse knew when they resigned. And when they resigned, there was a new audit firm that came in. This audit firm is called Norton Keen, and of course, Price Waterhouse should have told Norton Keen about what had been happening at Raymore Investments, particularly involving this Mr. S, but they didn't. Right? What they said was their resignation was for commercial reasons. And of course, the phrase commercial reasons could mean almost anything. Right? It could mean, for example, that Price Waterhouse wasn't happy with the fee that they were getting. Right? So this was a very vague kind of explanation that was given. Price Waterhouse didn't really tell Norton Keen the true reasons why they were resigning from the engagement. Now, it was even worse than that, because before resigning from the audit, the partner at Price Waterhouse wrote the following letter to this Mr. S. Okay, and this is what really created a lot of bad publicity for Price Waterhouse when this was revealed, because it basically indicated that the audit partner was colluding with Mr. S to keep secret what the auditors had found. So he says, as arranged, I'm writing to let you know in advance of the annual general meeting the replies I will give if I'm asked by a shareholder for the reasons why my firm is not seeking re-election as auditors. If no questions are asked, then of course no further information in addition to that contained in the annual report need be provided. Okay, so what he's saying here is, I'll only provide information if someone asks me questions. If no one asks questions, I'll just stay quiet. So then he goes on to say, well, what will his response be if a shareholder does ask a question? However, if a shareholder asks for further information, I propose to reply as follows. In recent years, we've experienced certain difficulties in obtaining the necessary information for our audit, of being sure that all relevant explanations have been provided to us. In the final outcome, we've been satisfied that we have received all such information and explanations, otherwise this would have been reflected in our audit report. However, the situation created by these difficulties caused us to agree with the directors that we would not seek re-election at the meeting, a step we are permitted to take under the provisions of the Companies Act. So you see there's this kind of very bland, uninformative disclosure here, right? No real information, no detailed information with specific specific details about what had happened was going to be provided to investors. Remember, what had happened was the auditors had found that Mr. S's personal accounts were mixed up with those of the company, and Mr. S had tried to deceive the auditors during the audit, but they weren't going to reveal that. And then this partner, Mr. A, went on to say, if there should be a follow-up question asking for more information, I would propose to reply as follows. There was no one matter which in itself caused us to reach this agreement with the directors. In view of this, there's nothing more that can be added to the answer that's already been given. Okay, so again, another very bland response without any specific details. And then I would not intend to give any more information nor to respond to any other questions. Okay, so you see here a couple of examples of ZBest and Raymore Investments where the auditors are not providing information to the incoming audit firm, and also they're not providing information to shareholders about why they're resigning from the audit. Okay, what I want to do now is to move on to the Code of Professional Conduct. The Code of Professional Conduct is basically the AICPA's way of trying to maintain auditor independence. Okay, so the AICPA has this code of conduct which applies on all audits. Okay, so you must comply with this code of conduct when you're working as an auditor. It doesn't apply to any situations where you're not working as an auditor. For example, if you're providing a tax service to a client and that client is not receiving audit services, then the code does not apply. So this code only applies for those clients that are receiving audits. All right, so the code contains general guidance and specific rules. The general guidance essentially is that you should be independent and be seen to be independent. Right? So it says an auditor should be and be seen to be honest, objective, competent, and exercise due care. So this first phrase that I've underlined is known as independence in fact, right? That actually you are independent. And the second one, be seen to be, this is known as independence in appearance. That is that other people believe that you're independent. So the general guidance is saying you should actually be independent and you should make sure that other people believe you're independent. So that's the first part. Now, of course, that general guidance isn't very practical on its own. So the AICPA also provides specific rules that are to guide auditors in what they need to do in order to maintain independence. And these specific rules are maintaining minimum standards of professional behavior. Okay, so you have to comply with these rules, right? If you don't, then you cannot be considered to be an independent auditor. So what are the rules? Well, they're listed here. I'm going in question 1 to talk about the rationale for these different rules. So I'm not going to go in great detail in this video talking about them because we'll cover them in class. The first one, you should not charge contingent fees. A contingent fee is where the fee paid to the auditor by the company is contingent on the outcome of the audit. Okay, and we'll talk about the reason for that in question 1. You cannot act as a director for an audit client, because if you're a director, then by definition, you're an insider of the company, and so you can't be independent. You can't accept significant gifts or entertainment from clients, obviously, because those could be used as a way of bribing the auditor. You cannot act as an advocate for the client. For example, if the client is negotiating with the IRS on tax issues, or if there are financial reporting issues with the SEC, right, you can't act in a kind of legal capacity as an advocate. You can't prepare the source documents that are used to generate the client's financial statements. You cannot have any direct financial interest in a client, where financial interest would include equity or a loan. You cannot have a material indirect financial interest in a client. And again, in question 1, I'll talk about what's the difference between direct and indirect, and what do we mean by material versus any financial interest. You cannot have unpaid fees owing from a client for services provided in a previous year. You can't audit a company where an immediate family member is in a key executive position. Okay, just like you can't, the auditor cannot be an executive or a director of the company, then an immediate family member like a spouse or a son or daughter or a parent, that would also apply. And then if an audit staff was previously an employee of the client, he or she wouldn't be independent if the financial reporting period under audit overlaps with the previous period of employment. So this is talking about a situation where a client employee moves to the audit firm, which doesn't happen very often. Usually the direction of travel is in the opposite direction, right, where the audit staff member leaves the audit firm and joins a client. This is talking about the opposite situation, where an employee of the client moves from the client to the audit firm. Okay, so in question 1, I'm going to ask some questions relating to those rules that I just talked about. Why are auditors not allowed to charge contingent fees? What's the difference between a direct and indirect financial interest? Why should auditors not start an audit when the client has unpaid fees from a previous year? And how significant is a restriction on audit staff who are previously employees of a client? Okay, all right, so that's where we'll finish today's video.